All right, well, welcome everyone to our third of four partnership workshops with our friends over at American Pacific Mortgage. I'm Josh Prue. I'm the Assistant Vice President of Alumni Relations here at the Yukon Foundation. It's great to be back with Jason and Ken from APM, and welcome to all of you tonight joining us. We're thrilled to be welcoming Jason Mehta from American Pacific Mortgage, who will be presenting today on all things that you need to know about buying your first home and mortgage process and everything else you might need, and answer any questions along the way that you have to help you along this journey. We're thrilled to see so many new names. About 30% of you have never engaged with us before, and we're thrilled that you're taking tonight as the opportunity to learn a little bit more about what we offer as your alumni team and partnering with great companies like American Pacific Mortgage to bring that to you. Next, as we move on into tonight's program, I just want to let everyone know that closed captioning is available. And I'm actually going to go into the chat in just a moment and make sure that everybody that does need that can see that. All you need to do is go down to your closed captioning button on your toolbar there, activate that, and you'll be able to see everything that you need to tonight to have full participation. If you have any questions tonight, we are open to questions and helping to make sure that if there's any specifics that we can answer for you tied to the mortgage process and the home buying process, that we can get that answered for you today. That is available on your Q&A button at the same toolbar that you have there. Jason and his colleague Ken, who will be in the background as well, will be able to answer questions for you, queue that up for you, maybe answer some live as well, and hopefully bring you all the content that you need to make this a successful and enjoyable evening for you. That being said, thrilled to welcome you back once again, Jason, to the stage
Thank
here.
you.
I know we've had some great dialogues over the last year or so. Thrilled to hear what's going on in the world of home buying and what else might be coming our way.
Yeah, thank you, Josh. Appreciate it. Great to be with everyone this evening. I hope you're having a great week so far. I got one more day left. Got Friday is right upon us. I do appreciate everyone spending a little bit of their evening with us. We promise to give you some valuable content in today's class. This is a home buying class that we provide for the Yukon alumni. And as Josh mentioned, this is our third of four installments for 2025. Got a lot of great participation in our communities. In the preceding workshops, we've got a chance to talk to a lot of fellow alum about guiding them through the path of homeownership. And so we hope that, we can give you 2-3 takeaways that can help you make, which is probably going to be one of the largest financial decisions you decide to make. And I do think the timing of our workshops kind of nice too, because I know a lot of us are transitioning back to school. We're kind of maybe almost cycling out of the summer season, but the buying season hasn't really slowed down in most parts of the country. So, we're going to spend some time really diving into market data today, but more importantly, help you better understand about affordability in homeownership and kind of overall preparing for the homeownership process whenever that time may be in front of you. As Josh mentioned, we're proud to be a partner here as American Pacific Mortgage. We are the 9th largest mortgage company in the country, and I'm proud to be one of the top producing team members within APM. And as a nationwide lender, we essentially go into our communities and help provide tools and resources around homeownership. Our team specifically partners with alumni associations like Yukon to deliver educational services in home buying. Again, my name is Jason Mehta, and I'm proud to be your presenter this evening. As Josh mentioned, we're going to make this a very interactive session. Our runtime will take us just about to the top of the hour, but as we interact with you in today's class, please feel free to use the chat or the Q&A function in Zoom. I'll be kind of monitoring both windows along with my colleague Ken. We'll be kind of monitoring to see what questions you guys have, and we'll make sure we get those answered for you on air. I'll also carve out a little bit of time at the end of class too if you have any follow-up questions. But of course, we would love to connect with you after tonight's presentation if you have any specific scenarios that you'd like to run by us. All right, so that's our plan for tonight, but let me kind of talk to you a little bit about our talking points for this evening. So we'll look at the housing market today, a lot going on there, especially as we kind of cycle out of the summer buying season. But we'll spend some time looking at the housing market, what's happening with interest rates. I think that's on the top of mind of most prospective buyers. And to that point, most existing homeowners, what's happening with rates. And then we're going to talk a little bit about buying versus renting. So if I continue to go down that path of renting and pay my landlord on a monthly basis, what does that look like versus if I decide to make the decision towards buying? So we're going to walk you through a rent versus buy calculator tool, talk a little bit about credit, some different tricks and resources in preparing your credit. So we'll give you some coaching around credit, talk a little bit about loan products and some of the guidelines, and we'll spend some time looking at savings for home ownership. That tends to be one of the biggest maybe hurdles for some of our clients in preparing for home ownership. So we'll not only look at that, but also spend some time looking at first-time homebuyer programs. They're available in most markets across the country. So whether you're in the Connecticut market or any other of the states across the country, there are first-time buyer resources available to you. And then, as Josh mentioned, I'm going to walk you through the buying process. So after you leave tonight's class, what does it look like for me as next steps or action items for me? So if I think I want to prepare for homeownership, whether that's a 2025 goal or something that's, a couple years out, how do you get connected with us to build your home buying plan? And then what are the courses or the course that I have to go down in order to eventually get the keys to my home? All right, so that's our plan for tonight, and looking forward to taking you guys through this journey of home ownership. So let's kind of launch into tonight's class. First of all, talking about the comparisons of buying versus renting, because ultimately for us as prospective home buyers, we have to figure out, is this a good financial decision for me, right? Well, as you think about that and position home ownership for yourself, here's how I would think about it. One is, you want to be able to create stability in your housing expense, and homeownership can potentially do that, especially in a high cost of living market like we all live in today. Many of our clients that are purchasing in today's market will probably consider refinancing in a couple years. So let's say I buy my home today at a 6.75% rate. Eventually rates trend down to 5.75. It might make sense for me to refinance and ultimately reduce my monthly payment as an existing homeowner at that time. Now, this is an asset that can grow in value over time. So as my home goes up in value, as I make mortgage payments and I pay down my balance, that number continues to the spread between the two numbers grows bigger and bigger, right? So that difference of value versus my balance is called home equity. For most across the country, that's their number one asset that they have. It has an opportunity to create generational wealth for some families. And when we also think about home ownership, we want to consider tax benefits that can potentially exist in owning a home versus continue to just pay my landlord a monthly rent and ultimately help my landlord pay down their own mortgage, right? There's also some tax benefits that can come along with owning a home by doing some type of energy efficient upgrades in your home. So as you consider repositioning yourself for home ownership, whether that's because of you want to have an asset that grows over time, or you're looking to control more of your monthly payment situation, home ownership can be a great vehicle to improving your financial situation. Now, as we consider that, I want to kind of first launch us into a rent versus buying calculator. This is one of the tools that we have available to our clients. It's part of our resources hub that we provide to our clients. So what I thought I would do is I'd walk you guys through this calculator just as a quick high level look at it. We are recording tonight's class, as Josh mentioned, but we're also going to send out all the slides from today's presentation, which will include the link to this calculator. I'd encourage our class, if you have some time, maybe dive into this yourself. Maybe you can do a little bit of just an exercise, just of a cross comparison of your situation today versus your prospective home ownership situation. So the way this calculator works, and I'll just kind of walk you through a few of the fields really briefly, but ultimately we're going to add in a price of home that we're interested in. And then based upon that price, we'll put a minimum down payment. And we're going to talk more about guidelines and program specifics in just a bit, but the minimum down payment for a first-time buyer is 3%. And then we have, based upon that 3% down payment, an amount financed, which you can see here. We have an average interest rate. So we put 6.5% just as a what if. And then we have the term of my loan. So in this case, it would be a 30-year fixed term loan. And then we say, okay, well, what if we bought today in today's housing market? So in August, we're buying, what is that going to look like for us? And then we look at PMI, or private mortgage insurance. We'll also talk about that topic later on tonight. PMI comes into play when we put less than 20% down to purchase my home. We'll have private mortgage insurance. We have the actual homeowner's insurance in my house, what my tax rate might look like, and that will vary based upon the community that I buy in. And then that would kind of really finish off the homeownership side of things. And then depending on what my tax bracket looks like, we'll plug that in. We have the cost of maintaining my house. What is it going to cost me to sell my house in a certain amount of time, right? Because we're comparing a timeline of owning versus renting. And then we have the appreciation rate in my home. So that all kind of gets put into the column under home ownership. And then on the rental side, we would have, this person has a rent of $2,000. They pay renter's insurance, and their rent will probably go up about 2% every year, right? So that's our kind of our cross comparison between renting and buying. Now, as we kind of pencil this out, our calculator tells us that after 4 years, it probably makes sense for us to buy versus renting. That's a cheaper opportunity as we factor in things like appreciation of my home, My rent not going up on an annualized basis, right? Also the not only the appreciation, but the tax benefits that come along with owning my home. And you can see that is going to help grow over time. So depending on how long I decide to stay in my home, so we put our calculator at 10 years, that 10-year mark creates an asset gain opportunity of $70,000 for this prospective buyer. Now, if this was a person that was paying $3,000 a month in rent, this buy opportunity would be even greater, right? So I would encourage you to run through that exercise yourself. And as a side note, this shows you what your equity position would be. So if I bought that $450,000 property, I pay down my loan over the next 10 years on a regular standard payment schedule, and my home appreciates. That's my value opportunity for growth in my finances, right? Okay. So I would encourage clients as they think about homeownership to start with an exercise like that, because so often clients will reach out to me and say, Jason, I'm paying $2,000 a month in rent. I think my budget is only $2,000 in mortgage. So when we think about it from that perspective, we're not factoring in all the value add components of homeownership that could lead us to better buying power or ultimately better asset accumulation over time. All right. So we'll send you out those slides so you can check that out. Now, as we're determining when and where we want to buy in the market, what the housing market is doing is going to play a really important role in that as well, too. So I wanted to spotlight the Connecticut housing market. Now, I didn't poll the audience to see where you're joining us from, but actually that's probably not a bad idea. If you have a moment, if you want to just put in the chat where you want to, or what's your intentions to buy at, or maybe where you're joining us from. We can talk about other housing markets if we have some time, but the Connecticut market looks fairly similar to the nationwide market just from a trend analysis standpoint. And we have somebody from California. So, okay, cool. A couple of people from California. All right, good. The Connecticut market, you can see a little bit of a decrease here. So a little bit on the downside, not significant, but some of this flattening right now in price or a little slight decrease. Some of it is around inventory levels. So we've actually seen inventory pick up over the last couple months. So after Memorial Day weekend, we saw a lot more inventory enter the market. So better supply. So we're seeing more competitive climate, if you will, for sellers, which is better for us as buyers, because as there's more opportunities or options for us as buyers in the market, that allows us to have better negotiating power with sellers. And so you can see 35 days is the median days on market in the Connecticut market. Median sales price of $492. That is up year over year, but you're starting to see a little bit of a slide in price. So we had a nice little uptick here earlier in the year, but now we're kind of cresting a little bit. Again, that looks very similar to what we see across the nation. Now, here's a kind of an interesting data point. So almost half, or 44% of all transactions being done across the country are factoring in some type of seller concession, meaning the seller is providing a credit towards the buyer's closing costs. So 44% of all transactions. So clearly sellers are a little bit more apt to negotiate. We didn't see that 2 years ago. And so, that's playing a big role in negotiating power for buyers. In some markets, we could call it a buyer's market. Certainly the inventory levels would show that, the negotiating power the buyers have. Right now, there's 4 states across the country that have the highest inventory levels. That's Georgia, Colorado, Texas, and let's see, in Florida. Sorry, missed Florida. So Florida, Georgia, Texas, and Colorado have the highest inventory levels right now. And those are markets that we support our clients in, and we're certainly seeing that with negotiating power. Now, a lot of buyers have been pushed to the sidelines because of where interest rates are at. I'm proud to say that right now we're right around the 2025 lows. We're really kind of watching really carefully what's happening with mortgage interest rates. And watching the commentary that's coming out of the Federal Reserve right now. And obviously in this geopolitical environment, there's a lot of pull and tug of war kind of going on right now with what should be done with interest rates. Based upon some of the recent data that has come in, there's about an 86% chance that the Federal Reserve is going to cut rates next month, which would be a really welcome sign. Now, as you're hearing economic news post that maybe the Federal Reserve does cut rates, it's not necessarily a direct impact on mortgage interest rates. As we get more clarity that they are going to cut rates, we'll start to see that already spill into mortgage interest rates. And that's what we've already seen happen as of late. When we get more clarity, there's certainty, if you will, that the Federal Reserve is going to cut rates, you'll start to see mortgage rates go down lower. So that would be an encouraging sign. It will directly impact cost of credit cards, personal loans, auto financing, things like that. So you'll definitely see that. We had a nice little move in just about 11 months ago in mortgage interest rates. We thought that was going to be the impetus to what's going to happen with lower rates, but we just have had a really choppy market throughout the last 12 months. But we're obviously going to be watching what the Federal Reserve has to do. Now, the reason why we're at these elevated rates is because the Federal Reserve is trying to control inflation. I think somebody asked a question about inflation in the chat, so I'll kind of take a closer look at that in a second. But ultimately, the Federal Reserve's mandate is to get to 2% inflation across the country. We're still elevated at 2.5. But the Federal Reserve is feeling some pressure to cut rates, and we're seeing data points come in that would suggest that the Federal Reserve should be cutting rates. We'll have to see how that kind of plays out. But I think as a consumer, you just need to understand that rates do cycle over time, and this 20-year look back kind of displays that. If you were to go 20 years from today, rates were about the same level as we see today in the market, but ultimately prices of homes looked obviously a lot different, and you can see kind of some of the economic changes or really impacts that we've seen in interest rates. So this represents the housing crisis of 2008 and beyond, and then this represents the pandemic. So I kind of showcase this for you guys just to say, rates, yes, they did hit 2.5%. It's probably not going to return to those levels. And so I think we need to prepare ourselves as future buyers. The average historical rate is probably in the high 4s to low 5s. That's kind of a normal rate. And certainly today we're at elevated rates, but rates will eventually cycle down. So I think those that are purchasing in today's market where let's say they're 6.6%, generally we'll start to recommend refinancing when rates can at least see a 1% full reduction in price. And that will probably take some of the existing homeowners refinancing in maybe 2027. All right. Okay, I'm going to try to keep up with the chat. Thanks for those of you that put your location in. That's really cool. We have folks joining us all across the country, so that's really helpful. I didn't want to make the assumption everybody was in Connecticut. And then I think we had a question is, how do you account for unannounced natural disasters? I think that was a question around the housing data. So these are just general data points. Certainly housing disasters can affect what's going on in the housing market. Things like cost of insurance is a really big deal. Like for example, in Florida, they're feeling the effects of insurance costs. California feels it. I see it in Texas, where it's expensive to insure homes. Therefore, it is impacting the activity in the market. Ultimately, homes coming off the market, and so that is a challenge. So I don't have anything specific on unannounced natural disasters, but I think that if impacts of insurance is really where it's felt. And then does the calculator account for inflation of goods or just increases in rent? It just assumes increases in rent. So we didn't get that granular with the calculator. Okay. All right, and I think Ken's helping out. So Ken, thanks for jumping on that, and I'll kind of keep things moving. Thanks for those questions, though. That's helpful for our class. Let's talk about what makes up interest rates. So there are characteristics that go up in an interest rate, and as the market has these movements throughout the day. So when the trading day opens up on Wall Street, that's when market activity starts with interest rates. So interest rates can change by the minute, and constantly throughout the day, I'm having conversations with clients. Even just before today's class, I was talking to a client about kind of where interest rates are at and hopefully where they're going. And that client that we're having the conversation, we also kind of talk about what goes into their interest rate. So we think about that. We look at credit score and eligibility for a program, the type of product that we're going to do, how much we decide to finance, and what my down payment might look like. And then one of the things, and this is one of the conversations I was having with the client, was should I buy down my interest rate by paying points, which are essentially additional expenses that you pay? A point is 1% of your loan amount, which will generally translate to a 0.25% reduction in interest rate. I don't recommend clients doing that because, as we've talked a little bit about refinancing, it will probably be about a 3 to 4 year recoup period for a client to do that. So it doesn't make a lot of sense to invest a lot of money in buying points. And then the term of my loan can also help benefit my interest rate. So if I do shrink down the term of my loan, that can also benefit me in reducing my interest rate. However, most first-time buyers are going to elect a 30-year term. As we get a chance to meet with you for your own home buying plan, we're going to figure out what the right design work looks like for you with your financing. And that could be a 20-year loan. It could be buying down points. But ultimately, I think it's important as buyers to understand it's not a one-size-fits-all when it comes to interest rates. Now, one of the biggest factors that plays into interest rates is really where your credit score is. So if I'm at a 720 score, versus a 780 score, that could be a significant difference in the cost that I pay for my financing. So in our workshop, we like to dive into credit, give you some tips and some resources or overall credit coaching to help prepare you as you enter homeownership. Now, as I mentioned just earlier, every product has a credit score or a credit score that can be the minimum amount. So we've actually put those on our screen here. So this is the minimum credit score by some of the more kind of core products that we offer. Now, we look at all three credit agencies reporting. So the three agencies that you guys are all familiar with, TransUnion, Experian, and Equifax, they all have three different score or risk models, right? That's why you see three different scores that appear for them. Now, there's also three different models to scoring. There's credit card, there's auto financing, and then there's mortgage model scoring. Now, of course, if you're going to apply for home financing, guess what? We're going to use the mortgage score model, right? But many of you that are doing your monitoring through Credit Karma or some of the other tools that are out there, they're going to use the credit card score model. And that's important to understand because you may think you have a 740 credit score, but then you do your mortgage score check and maybe it's 735, right? So there could be little subtle differences. I'm going to walk you through a mortgage credit score model here in just a second. So maybe we can identify some areas of opportunity for you. Now, we do take the lowest middle credit score between both borrowers. So if I'm borrower one and my top score is 780, my middle score is 760, and my lowest score is 740, well, my middle score is 760. So that's the score that we'll use from a qualifying perspective, right? However, if I'm going to apply jointly with a partner and my partner's at 700, 680, 660, their middle score is 680. So in this case, we would have to use the lowest middle score, which is 680. That's what would be used to determine the product eligibility, the interest rate, even the cost of mortgage insurance. So, understanding your credit and how we evaluate it from the lending perspective is super important. Now, when we think about maybe some past challenges that we've had in our credit report, maybe it was a late payment, we completely missed the bill, whatever the case may be, it's going to impact us directly in the most recent 12 to 24 months from the date of that impact or that event on my credit report. Now, the imaging or the impression, I should say, that's going to show up on your credit report will be based upon this matrix that you see here. So if I have a late payment on a student loan back from October of 23, probably my score has recovered a little bit because it's outside 12 months. It's just inside 24 months, but it's still going to show on my credit report. Okay. But if you've had any past challenges, you can refer to this matrix of how long it's going to stay with you on your credit report. Now let's take a look at the modeling for mortgage, the credit score model. So let's kind of take a quicker look at this. And so this is kind of the weighting of the mortgage credit score. So the first piece I'm going to kind of go through is length of credit. That's 15% of the credit modeling. And so when we think about that, that means essentially the more mature or the more seasoning I've had in my credit profile, potentially the better my credit score is going to be. So if I compare a client that has a 12-month credit history versus somebody that has a 12-year credit history, assuming all things being equal with payment history, that 12-year history should have a much higher credit score. So obviously the length of credit, how long we've had things, and then how much new credit. So there's a little bit of a balancing act here. I don't want too much credit, but I also want to make sure I have enough credit. And so when we think about how much new credit I'm trying to access, that's 20% of the weighting in the credit score. And so that looks at how many new accounts am I trying to open up. That looks at inquiries of credit. Now, there's two types of inquiries. There's a hard inquiry, there's a soft inquiry. Now, one of the unique things in how we help our clients is we only start with a soft credit inquiry. The reason why we choose to do that is because a soft inquiry does not impact your credit score at all. Now, most lenders will choose to do a hard inquiry, whether that's to apply for credit or auto financing or even home financing. But we understand what that can do to a client's credit score, so we only start with a soft credit check. And I'm going to just take one question really quick because as we're going to kind of go around the wheel here. Question was, if the buyer has a lower score than the co-borrower, will it hurt more than help? Should the co-borrower only use their credit information? So that's kind of to my point earlier. So we're going to look at the lowest credit score between both borrowers. So as we meet with you for a consultation, and let's say in my example where we had the first borrower at 760 and then the second borrower I think was at 680. So if we apply jointly, I have to use the 680 credit score. So it may make sense for us to just have only the financing, assuming they can qualify for what they would really like, to only use the 760 credit score customer. Okay. All right, so 30% is going to be around credit utilization. So we're looking at revolving credit. and we're taking a look at what do I have available to me in credit limits versus what do I owe in credit balances. So really simply put, if I have $10,000 in limits, I have $70 or $7,000 in balances. Right now I'm at 70% utilization of credit. So if I'm that high on the scale of utilization, I'm probably seeing some pullback in my credit score. Our first exercise or action item would be to encourage my client to get below 50% utilization. Once we've kind of figured out like we got some landing there, then we would go and try to work towards 30% utilization. And then the optimal level is 10% utilization. Now, my tip for class tonight is that if as kind of a homework assignment, take a look at one of your credit card statements. There's two important dates, obviously the due date. The other date is the billing cycle date. That is the preceding 30 days of activity on your credit card. So my recommendation to our class is if you can pay down that credit card or pay it off before the end of the cycle date, what you're going to do is you're going to get ahead of the reporting out to the credit agencies. And because when you close out that statement activity date, that's when the information goes out to the 3 agencies. So if I can take action and pay down that balance before the closeout date, I'm going to have a much better improved utilization of credit, therefore improving my credit score. Okay, the last part on the wheel here is payment history. That's essentially how I paid my bills. If I've had any late payments, they're rated as 30-day late, 60-day late, and then 90-day plus day delinquencies. Again, in the most recent 12 to 24 months is going to be the bigger impact to my credit score. So, the higher number of days I'm late, the more recent it is, the bigger impact I'm going to have to my score. All right, so hopefully that's helpful in understanding how we evaluate or the risk model for credit scoring as it relates to home financing. Now, tied into that is student loans, because student loans do report as installment debt to your credit bureau. And as we look at student loans, I just want to kind of give you a quick glimpse into how we look at it from the lending perspective, because some of you might be re-engaged and now making payments on your student loans, especially on federal loan debt. If you have a set payment right now, and let's say it's an income-based repayment plan or savings plan, for example, someone that has, say, $75,000 in debt and has a savings plan of $250 per month, we can use that $250 per month to qualify for the client. Where other situations where someone's like still in forbearance or they're in deferment and they're not currently active in repayment, then we have to apply this formula, which would say on an FHA loan, we need to apply 0.5% of that same balance to the monthly payment, which would be $375, or 1% on a conventional loan, which would be $750 per month. So I share that with our audience because I think some of our clients that I work with think that student loans will be just an insurmountable hurdle for them, but it's something we just need to kind of talk through and make a kind of more of a strategic move on how we position student loans in your financing, because we do have to look at them, because in financing, every loan product has a way that they view student loan debt or debt in general. And let's take some time now to kind of talk a little bit about loan programs. And I think we're all up to date on our questions. Before I do that, I think Ken's working with a few of you on some questions. Let me just make sure. Okay, let me just make sure that, okay. Sorry, I just got a long question there. I think okay, Ken's going to handle that one offline. Okay, cool. So, all right, let's talk a little bit about loan programs. And so I want to kind of just give you a high level look at each one of these programs. First one's a conventional loan. You might have heard of conventional, that terminology. We think about Fannie Mae, Freddie Mac. They're in the news quite a bit because they're talking about privatizing Fannie Mae and Freddie Mac, or kind of splitting them up. We'll see how that all goes. Not really here to have commentary on that, but ultimately with those agencies, it's a minimum down payment of 3% for first-time buyers, minimum score of 620, and then you have a maximum loan amount based upon where you're at in the country. The national conforming loan limit is 806,500, but I know we have one of our classmates that's in San Francisco, for example. We can go up to $1.2 million in that loan amount size. However, that minimum down payment that I just shared with you at 3% jumps to 5% when we have to stretch out to those higher limits. We call that the high balance loan limit. Now, the next product is an FHA loan. That's a government insured loan, minimum down payment of 3.5%, and it has lower credit score requirements, so a little bit more flexibility in qualifying. And then this max loan amount will vary based upon the county that you want to use for that product. Now, I want to kind of tie together FHA and USDA because these are both government insured loans. USDA stands for the United States Department of Agriculture, as you might have suspected. These products have seen some changes as it relates to qualifying with residential history or residency, I should say. So you do have to be a permanent resident to access these programs. So unfortunately, they did make some guideline changes just a few months ago where if you're a non-permanent resident, depending on your status, you would not have access to these programs. You do have to be a permanent resident. However, non-permanent residents can still access Fannie Mae and Freddie Mac loan products. The USDA product is basically designed for someone that wants to purchase in a rural area. So there's two qualifiers to USDA. It looks at the income qualifying for the household, and it has to be deemed a rural area by the market. The jumbo loan product is not going to be super popular for first-time buyers because it's really someone that has to stretch beyond the agency limits like the 806-500. We see that a little bit in our more higher cost of living markets like San Francisco or LA or some of our other markets on the East Coast. They're just higher cost of living, but not really typical for most of our attendees to class. The VA home loan is a popular program. Obviously, it's for our veterans that have eligibility. So it's reserved for the veterans that have entitlement for the program. Zero down payment option with the VA loan, minimum credit score of 620, just a lot more flexibility for the veterans to have that entry point to home ownership. Now, one of the things that comes up in designing home buying plans for our clients is the conversation around mortgage insurance. So in this part of class, we're going to talk a little bit about mortgage insurance as it relates to conventional home loans, and then mortgage insurance as it relates to government insured FHA loans. So there's a little bit of a misconception with PMI about the cost of PMI. People think this is a massive number, especially when you start getting on calculators that are on the Zillow or Redfin sites. PMI it's not as expensive as you might think on conventional loans because it's based upon a few kind of risk criteria. So it's based upon down payment, credit score, and then how much you decide to finance. Okay, so it's kind of that's what's assessed to make up the premium for private mortgage insurance. Now, what is PMI? Well, PMI provides insurance to the lender against default by the buyer. So if the owner had a financial hardship and was unable to pay their mortgage, the mortgage insurance company would essentially insure the lender against the default by the buyer. Now, one of the appealing aspects of conventional mortgage insurance is that once I reach 2 years in my loan and I have 20 to 22% equity, I can apply to have the mortgage insurance canceled. So that's a big part of PMI for a conventional loan. So to my point earlier about the cost of PMI, here's an example of PMI down here. So someone that's going to finance $450,000 has a 740 credit score. We're probably looking at a premium of around $183 a month. So, I mean, it can go lower than that if my credit score is higher, if I can increase that down payment, but that gives you kind of a sense of what the cost might look like. Now, on the other side of the equation is an FHA home loan. And I know we have a question in the chat on this, which I'll comment in just a second. FHA loan is going to have a little more flexibility for the buyer because the qualifying is a little bit more flexible, but it does have two forms of mortgage insurance attached to it for this government insured product. One is the monthly MIP is going to be, well, there's on a monthly basis, which is 0.55%. And there's also upfront mortgage insurance, which is 1.75% of my loan amount. So that 1.75 gets added into the total amount financed. So I do increase my balance slightly when I have this type of product. Now with FHA, I only have the option to get out of mortgage insurance. So even though my home explodes in equity, I still have to look to refinance in order to cancel my mortgage insurance. So many of our clients will use FHA as a starting point or entry point to homeownership. And maybe they need to utilize that product because maybe some credit challenges or maybe they're a little bit overextended. But we can always use FHA as that starting point and then look to refinance down the road. And then here's another example of the PMI, but as it relates to FHA. So taking that same loan amount, we have the upfront mortgage insurance and then the monthly mortgage insurance, just to give you some perspective. So one of the questions that came in the chat was, for an FHA loan, does the house have to be in tip-top shape? So FHA versus conventional, I will say FHA will be scrutinized a little bit more when it comes to the appraisal. An FHA appraiser is going to go around the house to make sure every plug works, make sure the HVAC turns on and off, make sure the dishwasher works, is going to check all the bells and whistles. And I think as Ken mentioned, it's going to have to be free of any health and safety issues. And for the most part, conventional will look at that the same way. However, conventional may have a little bit more flexibility. Maybe there's some issues with the flooring. They might not necessarily go and check every plug to make sure it works, but they're going to do some general visual inspections where an FHA appraiser is going to dig a little bit deeper. All right, so hopefully that answers your question, but that's a good one. That definitely comes up quite a bit from our prospective buyers. All right, so let's kind of pivot a little bit. Now, I want to talk really quickly about employment for home ownership, just to give you a quick little insight in how we look at that. I also want to pass along some general documentation that we would say would be wise to prepare for as you think about home ownership. So let's talk a little bit about like employment in general and how we view that from a lending perspective, because there's a little bit of misconception out there of what's needed or what the requirements look like. So in lending, we have to verify a 2-year history. And that 2-year history is not necessarily just work history. It can be inclusive of educational background. So, I always use the example for our classes that if I just graduated from UConn in the fall and I just started my job January 1, even though I've been on my job for only 8 months, I can still use, let's say, my undergrad with UConn to supplement that 2 years that I need to get for employment history. Okay. So you don't necessarily have to have 2 years on the job or even 2 years actual working history to necessarily qualify for mortgage financing. Now, if you're a self-employed individual, let's say you have your own business, you started it up 2 years ago, you do have to show that you have 2 years of tax filings in order to use that income for qualifying. Now, if you have a dual employment situation, so let's say you work for 2 different employers, working maybe 30 hours at one and 20 at the hour at the other employer. So if I do want to count both streams of income, then I have to, in that case, show that I've been on both jobs for 2 years. Now, for clients that have variable compensation components to their income, so let's say I have a base salary of $80,000 and I can earn $20,000 in bonus or commissions, right? In that case, because we have a variable compensation component, if I want to include that into my qualifying, then I have to show that I've been with my employer consistently for 2 years, because an underwriter has to look at that income, the variable source, I should say, and average that over 2 years. Because I may have made $20,000 in bonus in 24, but maybe this year I'm on track to make $18,000. So that's how we would look at that in qualifying. And the other thing I just want to pass along to you guys is that if you have a situation where, let's say, your income is the one that is going to be on the application, but you have other sources of income, like let's say a partner that contributes to the household, we can't recognize your partner's income unless your partner is going to be a part of the loan application. All right. So those are some of the questions that we get quite a bit in employment. Now, we also analyze employment or income, I should say, versus your expenses in qualifying for financing. So I like to pass along just this formula to our class. It's called debt to income ratio. It measures your existing debts you have versus your projected debts with the new house payment. So if we were to look at your housing payment of the principal and interest of the loan, taxes, homeowners insurance, PMI, if you put less than 20% down, maybe you bought a condo or a townhouse, you might have homeowners association fees. So we bake that into the projection of housing payment plus your other debts. And then we don't want to see those expenses consume more generally than 45 to 50% of my pre-tax income. So here's an example of what that looks like. So we had someone that has, let's say, a $3,000 mortgage payment. They have $500 in debts and they're making $10,000 pre-tax per month. Right now, they have 35% of their expenses coming out of their income, right? So the question I get from a lot of our clients that I work with is, where should that number be? I would say the excellent or comfort level for most clients is around 33 to 36%. That's typically where we see it. But there are clients that are buying in high cost of living markets or maybe have income sources that they can't document. So maybe that debt to income ratio is a little bit higher. But those are conversations that we have with our clients. Ultimately, what we do when we build a home buying plan is we're kind of really focused in on affordability, which for all of us in class or all of us across the country for that matter are focused on affordability, right? Just given the nature of kind of where things set today. But those are conversations that we have as part of your home buying plan for you. Last component to home ownership before we talk about workflow is savings for home ownership. And that's probably one of the bigger items for most of us in class is figuring out, like, I really want to buy a house, but maybe I'm just lacking the savings for home ownership. And so I want to kind of talk to you a little bit about simple approach to savings, but then we're also going to talk about assistance programs. And that actually was one of the questions we just got in the chat. So just give me like 5 minutes, then we're going to talk about assistance programs here. I also wanted to pass along just what are some of the verifiable asset sources that we can accept as a lender, because we get some confusion around that. Cash is not allowed in home financing. We do have to paper trail everything that's used in a real estate transaction. So generally, we want to see assets seasoned 60 days. Now, you can use retirement accounts like 401ks, 403bs, even brokerage accounts. Those are all acceptable sources of assets. And of course, checking and savings accounts can be used too. Now, we at times will have family members that want to contribute to the home purchase, and that is something that can be absolutely allowed. Gift funds do not require any type of seasoning to the transaction, but we do have to document where those gift funds are coming from. And you can see kind of some of those bullet points here. Now let's talk a little bit about savings for home ownership. And I think that's a really big opportunity for most of us, which is, I can afford the mortgage payment. I'm on track with my career. Everything looks great, but I just don't have that nest egg built up because I'm new in my job and maybe I'm still trying to get through some student loan debt, whatever the situation is, right? So here would be my coaching for our class today, which is to say, okay, if I can afford $3,000 on a projected mortgage payment, but I'm paying $1,500 in rent today, right now I have about a $1,500 variance in my budget. So what I would encourage our clients to do is let's start saving like we're actually making the projected mortgage payment today. So on the first of the month, when I'm paying my landlord the $1,500, I create that habit, or if you want to call it discipline, to transfer another $1,500 to my savings account on a monthly basis. And so as we can suspect, that savings will grow over time, right? So after 6 months, if I keep up that habit, I have $9,000 in my savings account. By the end of the year, I have $18,000 in my savings account. That's not to mention if you put it into a high yield account with whatever institution, we can compound some interest. So that is a great but simple approach to actually building your savings for home ownership. And it also can help you create that discipline of, hey, when I transition to home ownership, it's not such a big leap for me to go from $1,500 a month to $3,000 a month because I've been doing it for the last 12 months. All right. So that's kind of an approach to savings. Now, we had a request in the chat, which we always talk in our classes around first-time homebuyer assistance programs. We do offer a variety of different programs all across the country. So the way it works with assistance programs is generally there'll be a state agency that offers assistance programs. They call those HFAs. So in Connecticut, it's the Connecticut Housing Finance Agency. If you're in California, California has the California Housing Finance Agency. If you're in Colorado, they have a similar agency. If you're in Texas, Texas has the Texas State Affordable Housing Program. So there's a variety of different assistance programs. We are an approved lender with all of the programs that are out there as a nationwide lender. So we can certainly coach you through some of those options with those assistance programs. Here's kind of a look at some of the Connecticut-based programs. And I'll kind of share with you just quickly one of our nationwide programs that has become pretty popular. The Connecticut HFA program can provide up to $15,000 in assistance that doesn't ask for repayment of the assistance until you either sell or refinance in the future. So there'll be some eligibility or income requirements around that, which we can meet with you to discuss. There's the time to own assistance program, which has a forgivable component at the end of forgivable at 10% per year that you've occupied the home, up to $25,000. There's also the HFA Advantage loans, and there'll be special discounts that are available for first responders, military, and for teachers. So you see a lot of assistance programs that are attached to those special incentives for folks in those career paths. So that is an opportunity to help kind of decrease the out-of-pocket expense for you as a prospective buyer. We also have a nationwide program. It's called Pathway DPA. The difference with what program like this, it is only offered under FHA, but it does not have income limitations to it. You are repaying the assistance that you receive, but it will just be a little bit more flexible in the qualifying, because generally some of the first-time buyer programs will be targeting audiences of income that are 80% or less of median income, up to 150% of median income. So that's just something to kind of consider, but we can certainly support you with any of your needs around assistance programs. All right, so now we're going to kind of talk a little bit about the workflow of buying. So after leaving tonight's class, hopefully you have a lot of good takeaways that are kind of getting your wheels turning about home ownership. But I want to explain to you the workflow of buying a house. And this is the general workflow for most markets across the country. So after leaving tonight's class, we would encourage you to get connected with us for a free consultation. That's where I get a chance to meet with you one-on-one virtually, just to kind of figure out what does the finances look like? How can we best support you? And so that's where our first kind of step goes. And depending on when you want to buy, that consultation builds us a profile that we can issue now a pre-approval out of that consultation. And a pre-approval doesn't mean I have to go out and run out and buy a house tomorrow, but it just gives you the blueprint for home buying. And that pre-approval is good for 60 days, but we can always reaffirm or recertify that pre-approval at any time. There's no like additional hoops that you have to jump through for that. Now that pre-approval gets customized and maybe tweaked a little bit as you begin the next phase, which is the house hunting phase. So that's really the home search in the process. That house hunting phase generally is the longest cycle of the workflow of buying, because generally from accepted offer, which is the next milestone that we'll talk about, to getting the keys to my house, it takes about 30 days. All right. But hey, if I want to be in a certain neighborhood, it might take me a little bit longer. If I want a specific house design, it might take me a little bit longer. So I might have a smaller filter to what I would consider in my home search. Now, in house hunting, we would recommend you connect with a realtor in your local community. They should be an expert and well connected in your community. And we do have a list of preferred realtors that we can introduce you to if you need that resource. Now, we have a lot of interaction with our clients in step 2, because after we've issued your pre-approval, we'll be working directly with your realtor and with you in different scenarios. You may love this property at 123 Maple Street. You want to know what the numbers look like. We're available by text or email or phone just to run through those scenarios for you. Now, once you've identified a property that you want to purchase, you're going to submit an offer with your realtor on that property. Now, it may take a few shots to get that accepted offer, but ultimately one of those will eventually translate into an accepted offer where you have a ratified agreement with a seller. Now, when that happens, you're going to get a call from us saying, congratulations, you did it. Your offer is accepted. Let's walk you through what next steps look like, and let's schedule you for your follow-up video consultation so we can kind of redefine what your financing looks like and kind of just go through back some of the conversations that we had at your pre-approval stage. So that's what kind of happens as next steps. Now, you will also have action items at step 3, like making an earnest money deposit, which is a financial investment into your home purchase, just to show the seller that you have a financial stake in the success of this real estate transaction. In most parts of the country, that deposit is like 1% to 2% of your purchase price. Now, also in most contracts across the country, they all have some type of contingency to the contract. It looks different in different parts of the country, but I'm just going to give you a kind of a high level look. There's an appraisal contingency. There's an inspection contingency. Whoops, we bounced around a little bit. Appraisal contingency, which we're going to ensure the house is worth what you're buying it for. Inspection contingency that you'll work with on your realtor to ensure the house checks out, to make sure that there's no like apparent issues. Loan contingency to ensure the loan gets approved for your financing, right? And generally that happens within the first 2 to 3 weeks of your set contract period. Now, as I mentioned, from accepted offer here to getting the keys, it takes about 30 days. And your contingency period will be inside of that. Now, as we move through these milestones, they'll have varying timelines, but step 4 is essentially the administrative side of the business. So we're going to verify employment, your assets, repull your credit. At that time, that's generally when we'll do the hard credit check, and just make sure your design is all done for your financing. And that'll take us to step 5. Step 5 is going to be the loan approval phase. An underwriter reviews everything, for your financing, just to make sure that the loan checks out and meets all the guidelines that we reviewed in our product segment. Make sure that all checks out. Now, as you go through each one of these milestones, you're going to be getting e-signature disclosures. So everything is e-signature throughout this steps of the process. Now, at step 5, we will deliver to you a final closing disclosure, which essentially gives you a 3-day cooling off period before we go to the very final milestone. And that's really the finish line. It's called closing the loan. The timeline for closing looks different in different parts of the country. But ultimately it's about a 2 to 3 day process, maybe. And then at closing of the loan, you're going to be signing final loan documents in front of a public notary, maybe an attorney, maybe an escrow officer or title officer, depending on the state. That same day, you'll be wiring the final amount that's due in your transaction. And as your lender, we'll be wiring in the mortgage funds as well as maybe an assistance program if you have elected that. So that'll be all part of the funding process of your loan. Now, those funds get then settled up by an escrow or title office, and then documents get recorded with the local county to transfer the ownership, and then they record the instrument of the loan that you're getting from us, all right? And after that's done, then we get a chance to make our favorite call of the day, which is to say, hey, congratulations, high five, you did it, you're now a new homeowner. Absolutely, bar none, the best part of our day. We get a chance to celebrate with you. It's a huge accomplishment, huge financial milestone. And so we're right there with you, right? And our relationships don't stop there with our clients. Part of our aftercare is making sure we're staying connected with you to update you on market changes through our HomeBot system. What's the appreciation look like in my home? Does it make sense for me to refinance? And our rate watch system will help you with that. And we're always checking in with our clients annually because let's face it, things change all the time financially for us. So we want to make sure your home is working for you. All right, well, we're getting to the end of class. I think we're doing great on time. Ken is just like getting all those questions answered. I'm sure he's going to be a little sore after tonight's class. So you guys are doing a great job getting those questions in. I'm going to kind of scroll back to a few of those and answer anything I can, maybe just put some more details to it. Now, if you're thinking about moving forward in the process and you want to get connected with us for a free consultation, I'd love to get a chance to meet with you virtually or have a conversation with you. Here's our 3-step process. It includes a really simple online application, soft credit check, as I mentioned earlier. You'll upload some documents, and then we'll meet with you virtually if you're comfortable with that, or by phone. It is a 30-minute session or longer if we need to, just to help really understand how we can help support you with this financial decision. Here's what our consultation looks like. This is very similar to what you've heard in tonight's class, but we want to understand, where do you want to buy, because there might be some assistance opportunities for you. What does your budget need to look like? Can we identify some coaching opportunities in credit? Can we help put together certain financing options that can make it a little bit more affordable for you? All those things will come out of that pre-approval or free consultation that we do. Last thing I just want to point out to you is we embrace technology, whether it be mobile, some of our AI features, and some of our tools that we have. We understand technology can be an efficient and powerful tool for you. Doesn't change what we do from a human touch perspective. So we're always available via email, text, call, whatever you need. But I think you'll find the mobile tool would be really helpful to start the process, but also kind of follow what's happening and do some calculations on your own about affordability for certain homes. And finally, not only do we have, I think, our pretty cool classes for you 4 times a year, but we also pass along a discount to you in our UConn Alumni Partnership. So we discount our services to you, and of course provide access to these recorded classes for you, and provide you also with the different assistance resources for you too. If you like what you've heard today and you have friends, family, maybe some coworkers that might benefit from a class like this, feel free to have them check out some of our available classes, not only through the UConn Alumni, but some of our other partnerships across the country. We're really passionate about serving our communities in affordable home ownership. We understand the challenges most face today. So we want to make sure that you understand what your options look like for you in your local community. Here's all my contact information. So feel free to reach out to me, send me a text, whatever's good for you. And of course, you can schedule a time if it's a little bit easier for you. And this is all of our socials. You'll see this class that we're obviously recording. We will push out the slides from today. You can see also all of our pre-recorded classes on our YouTube channel. So if you want to look back at some of the previous classes, you can see those all available to you. And with that said, I have a little bit of time left in our class. Before I turn it back over to Josh, I'm going to scroll through, just make sure I didn't miss anything. I know, like I said, Ken's been knocking out the questions, but let me just make sure. Okay. Okay, I'm going to take this one on, Josh, really quick before we wrap. In addition to the down payment, what amount of money should we have available for closing fees, lender and realtor total amount, et cetera? So good question. So depending on what your down payment looks like, we'll have the down payment. So let's just hypothetically say we have a $500,000 purchase price and we want to put 3% down. I would say we want to carve out $15,000 for down payment. And then for closing costs, and we call prepaid items. Prepaid items could be things like your homeowner's insurance for the first year, some of the prorated taxes for my tax assessor's office for my community. Things like that will be prepaid items. I recommend clients to budget another 2 to 3% of their purchase price for those items. So if I'm buying a $500,000 house, maybe I need $25,000 to $30,000. Now the other question that comes up, which is in your question too, which is realtor fees. So when you have a broker agreement with the realtor, it indicates how much the realtor is getting paid for in the transaction, but it's not assumed that you as a buyer have to pay those realtor fees. A realtor can actually negotiate to have their fees paid for by the seller. That was a law that changed, several months ago, that you have an agreement for a broker to represent you. Okay, so hopefully that answers your question. And I don't think I missed anything. Okay, I think I got it all. I know we're going to connect with a few of you offline because I think you had some specific questions that Ken was going to take your information and we'll email you directly. Awesome. Okay. I think we're there, Josh.
I think so too. I'm not seeing any other questions rolling through the chat or in the Q&A, but I think you covered it all. I mean, that's a pretty marathon filled hour there.
Yeah, I know my jaw's a little sore, but okay, I got through it.
I wonder, I'm curious if you ever take some downtime after you're done with this and just not say a word for a while, but
I
I know
know,
you're in
right? Yeah.
sales too, so that's something that's part of the job. So,
Yeah, I just leave our studio. I say, Ken, don't talk to me. No.
well, we really appreciate your time,
Yeah,
Jason. These are always educational and full of information that really just changes all the time with different regulations that are constantly making its way through federal and local regulations. So thank you for taking the time to go
yeah,
through all this.
absolutely.
Obviously, all of us are waiting on interest rates and what's going to happen there. I think all of us are curious about what's going on there and how that's going to
Yep.
impact things. But I think you covered it all, and we're excited for one more of these this year. You're going to see us
Yeah.
again on October 15th for those that want to recommend others take a part of this. You'll have more information coming your way tomorrow. There was questions
Perfect.
about the recording where you did record this. That'll be coming your way along with the slide deck. And then obviously ways to contact Jason and find out about those UConn alumni discounts that they offer as well. So
Awesome.
huge thank you again to Jason, to
Yeah.
Ken for handling the back end and all the questions coming that way. And for all of you for joining us tonight, we really appreciate you and tuning in tonight from wherever you are across UConn Nation. So thanks everybody. Thanks Jason. Thanks Ken.
Good night,
Thanks all.
everyone. Have a great day. Bye.
Take care everyone.